Hello and welcome to my latest video, this time on inheritance tax. My name is Lucy Orrow and I have over 25 years experience in tax and am a senior tax manager at Lambert Chapman. Today I'm going to talk to you about what inheritance tax is, how it works and what you can do now and in the future. Inheritance tax can be payable both in life and death, and I will focus today on the liability due on your estate on death. Currently, the rate of tax payable at that point is 40%, subject to charitable relief, which can reduce it to 36%. More on that later. There are various reliefs and allowances, and I will go through the main ones today. Let's look at an example. So here we have a man who runs his own business, a limited company in which he owns shares and has lent money. His wife also works and owns a property which she rents out. This is their second marriage, and he has children from his first marriage. Let's call them William and Kate. Currently, William has an estate comprised of the following: shares in his business, a loan to his business, a pension pot, half share of the marital home, ISAs and other savings, and personal possessions. Kate has an estate made up as follows: pension pot, her half share of the house, her rental property, her ISAs and other savings, and her personal possessions. This table shows their total estates. William has a total estate of £805,000 and Kate's estate is £765,000. Taking their total estates, I assume that their pensions are written into trust and so fall outside their taxable estate. You can ask your pension provider if your pension is in trust. This is a quick and easy task and can save lots in inheritance tax. William has owned his own business for some time, and it is a trading company which meets the rules for business property relief. This means his shares will be exempt from inheritance tax and so reduces his estate. Each individual has access to a nil rate band of £325,000 on death, assuming no gifts have been made in the previous 7 years. William has children and he intends to leave at least some of his estate to them on death, and so he can access the residential nil rate band of £175,000. Kate does not have children, and currently she does not want to leave anything to William's children, and so cannot access the residential nil rate band. As you can see, William does not have a taxable estate, but Kate will owe 40% on her estate of £320,000, giving a liability of £128,000. So what can be done? Firstly, and most importantly, make a will. If you do not, your estate will pass under the intestacy rules and not necessarily as you would wish. Secondly, consider making some gifts. Everyone has access to an annual exemption of £3,000. This can be gifted to anyone for any reason, and inheritance tax won't be payable. Remember, this is available each tax year, and if you haven't made any gifts, then you can bring forward the allowance from the last year to increase the amount you can gift before the end of the year to £6,000. For a husband and wife, this can double to £12,000, giving an IHT saving of £4,800. There is also a small gifts exemption of £250 per person per year. This is often known as the Christmas present gift, to allow covering the liability of presents given to your loved ones. Finally, regular gifts out of income can be exempt from inheritance tax. It's important that you retain records of any gifts so that a pattern can be established. Finally, make decisions. As Kate's stepchildren or adopted children, she could leave her estate to them and obtain the additional £175,000 of allowances. How does she feel about this? Is it worth saving £70,000 in inheritance tax, or does she have other beneficiaries in mind? Kate could choose to leave part of her estate to charity. If 10% of her estate is left to charity in her will, then the inheritance tax rate reduces to 36% from 40%. William and Kate are still young, so if we move forward a few years and show how their estates have grown and what impact it has on their tax position. William's business has expanded, but some of the loan has been paid off. Their home has increased in value, as has Kate's rental property. In addition, they've been able to save more. As you can see, their total estates have increased. William's business is still entitled to business property relief, and so although his total estate has grown, his inheritance tax liability has not. Kate, on the other hand, does not have these reliefs, and as her rental property grows in value, so does her estate. This now leaves her with an inheritance tax liability of £190,000. So what happens if Kate dies and leaves her entire estate to William? Under the spousal exemption, there will be no tax on first death, and William will have access to Kate's unused allowances, remembering that she does not have access to the residential nil rate band. So on William's death, there will be a tax liability based on the remaining estate. Luckily, the estate after non-taxable items but before reliefs is just below the £2 million. And so the residential nil rate band will not be restricted. Where an estate exceeds £2 million before allowances, then the residential nil rate band of £175,000 is restricted by £1 for every two. So an estate worth £2,350,000 will have no residential nil rate band allowance. This is why reviewing your estate is so important, so that you can understand your position. At Lambert Chapman, we are here to help assist you with this process. So if you have any questions, please do get in touch.